If I told you that prices rise simply because there are more buyers than sellers, I'd be misleading you. In today's financial markets, that statement is flat out wrong, and believing it is exactly how institutional players offload risk under retail traders. In this video, I'm going to show you how price actually moves using real supply and demand, the order book, liquidity, and Wyckoff-style logic in a way that will permanently change how you see charts. By the end, candles won't look random anymore. You'll see a constant battle between aggressive and patient money. Here's what you'll understand after this: why the more buyers than sellers idea is a myth, where true supply and demand really exist, who actually pushes price, how liquidity gaps create explosive moves, and how volume versus price reveals the fight between institutions and retail. Let's start by correcting the biggest misconception in trading. People often say, price went up today because there were more buyers than sellers. It sounds logical, but it's impossible. For every trade that happens, there is one buyer and one seller. The amount bought always equals the amount sold, no exceptions. So price doesn't move because extra buyers magically appear. What does change is this: who is more aggressive, who is willing to wait, and who is forced to accept worse prices. Price moves when one side attacks and the other side either can't or won't absorb that pressure anymore. To understand this, you need to know the difference between two types of orders. First, limit orders. These are patient orders. I want to buy at this price or lower. I want to sell at this price or higher. These orders sit quietly in the order book. They create real supply and demand. Second, market orders. These are impatient orders. Fill me now. I don't care about price. Here's the key insight: limit orders are supply and demand. Market orders are what move price. Market orders cross the spread, consume limit orders, and force price higher or lower. In Wyckoff terms, supply and demand live in resting limit orders. Price movement happens when market orders attack them. So what actually happens when price goes up? Price rises when market buy orders aggressively consume the sell limit orders at the ask. If buyers keep attacking and sellers at that level get used up, the next available sellers are higher and price jumps. Now add stop losses into the mix. When short sellers place stops above resistance, those stops become market buy orders once triggered. That's how short squeezes form: forced buying stacked on top of real buying. Price drops for the opposite reason. Market sell orders slam into buy limit orders at the bid. When those bids disappear, the next buyers are lower and price falls. Long traders' stop losses turn into market sells, creating liquidation cascades. So the summary is simple: market buys lifting offers push price up. Market sells hitting bids push price down. Not more buyers than sellers, just more aggressive buyers or sellers. But sometimes price doesn't move because one side is strong. Sometimes it moves because the other side disappears. Imagine a grocery store. Water costs $1 today. Tomorrow, most suppliers vanish and shelves are nearly empty. You don't need a flood of buyers to raise prices. Even a few customers are enough because supply is gone. Markets behave the same way. When sellers pull their limit sell orders, the ask side becomes thin. Small market buys can cause huge rallies. When buyers pull their bids, the bid side thins out. Even modest selling can trigger sharp drops. This is called a liquidity gap. Price doesn't explode because everyone suddenly turns bullish or bearish. It explodes because there's no one left on the other side. Wyckoff described these conditions as no supply or no demand, critical clues for trend continuation or reversal. Now let's bring in Wyckoff's most powerful concept: volume versus price, effort versus result. Think of it this way: volume is effort. Price movement is the result. You don't need to know exactly who is buying or selling. You simply compare how much effort was used to achieve the result. Here are the key patterns. First, high volume, small price movement. Huge effort, tiny result. One side is attacking, but the other side is absorbing. Example, massive buying into resistance, but price barely advances and closes weak. That tells you strong sellers are sitting above. Second, high volume, large price movement. Big effort, big result. One side is clearly dominating. Depending on context, this can signal a powerful breakout or a climax near the end of a move. Third, low volume, large price movement. Small effort, big result. The opposing side has vanished. That's a liquidity gap in action, often seen during trend continuation or thin, manipulated markets. So every candle asks a question. Given this level of effort, is the result strong, weak, or suspicious? That's how Wyckoff reads the battle. All of these mechanics, order types, liquidity, volume, fit into Wyckoff's larger market structure. Phase 1, accumulation. Large players quietly absorb supply from weak hands. You'll see heavy volume on down moves, but price refuses to make new lows. Phase 2, markup. Demand takes control. Pullbacks are shallow. Down bars shrink in volume. Breakouts actually follow through. Phase 3, distribution. Institutions sell into public demand near the top. Strong up bars appear, but there's no continuation. Supply is overwhelming demand. Phase 4, markdown. Supply dominates. Rallies are weak. Up bars show low volume. Price rolls over again. Your job as a trader isn't perfect prediction. It's understanding who is accumulating, who is distributing, and which phase the market is in. Let's wrap this with a simple checklist. Next time you open a chart, forget more buyers than sellers. Ask who is more aggressive. Think in orders. Limit orders create supply and demand. Market orders move price. Watch liquidity. Thin books create big moves. Deep books absorb pressure. Compare effort versus result. Look for absorption, dominance, or disappearance. Place the market in the Wyckoff cycle: accumulation, markup, distribution, or markdown. Ask yourself, are you trading alongside strong hands or providing their exit liquidity? Once you see markets this way, you stop chasing green candles. You start spotting absorption. You see traps forming, and you recognize where real opportunity lives. If this perspective opened your eyes, drop a comment below and tell me what clicked for you. Because once you understand how price truly moves, you can never unsee it.